Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 7:03 a.m. Central Time, and I'm recording this in preparation for the market day of October the 22nd, 2015. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's dive on into our morning report. And we've got generally bullishness going across all four broad market U.S. indices. S&Ps are up about a third of a point, a third of a percentage. Russell's also up about a third of a percentage. Nasdaq's up about 0.5%, and the Dow's up just barely above scratch. Crude oil up about 1.39%. Euro down about just about scratch, just marginally down. As is bonds, also marginally down, and gold is also right sitting on scratch. China is up about 1.4%. Hong Kong going the opposite direction, down about 2/3%. Japan down about 2/3%. Germany up about a third, and United Kingdom down just marginally. So that's a pretty mixed picture, mostly positive. But certainly the overseas markets are pretty mixed, even within their regions. For example, China up sharply, Hong Kong down fairly good. And then you have Germany up by a third and United Kingdom down a bit. So pretty mixed picture. Could portend for some chop for us today, but we'll see how things actually develop at the open when all the market participants are in. In terms of macroeconomic reports for today, we got the regular weekly unemployment claims. We also have existing home sales, natural gas storage, and that looks to be about it for the United States. In terms of Friday, just flash manufacturing PMI, but that seems to be about it. So it's been a fairly light week there. In terms of current volatility conditions, you see the short-term VIX, a little bit of an increase after yesterday's action, 16.67. You see the skew still elevated, but not as high as the readings that we've had at some point this week. Obviously, a lot of people were loaded up and ready for a bit of a pullback, and we got that yesterday. IV percentile, they're up a little bit, but these are still very low levels. 20 for the S&P, the Russell 22, Nasdaq 20, and Dow 21. We did have a 2 standard deviation move put in by the Russell yesterday, though the others had less than a standard deviation move. So Russell continues to be significantly weaker than the other markets. And the first hint of weakness in the broad markets, the Russell seems to take a pretty good pounding. So if you're doing some hedging and so forth, you might want to think in terms of the Russell being the first one to go down and the one that goes down the most. Would probably be the most responsive to your hedging activities. In terms of the regular morning report, we're still phase 3 bull flags. We're thinking that any pullbacks should be relatively shallow, and that the bulls will ultimately reign. But that doesn't mean we won't have pullbacks, and we certainly are kind of anticipating one right now. Though the markets look to be up from yesterday's weakness, and this could be already over with. We'll have to wait and see. IBD status is confirmed uptrend. Accumulation distribution for the S&P is a B, but the Nasdaq significantly weaker at a D minus. GMI index, of course, we've seen in the last couple days, this has improved dramatically. It's now a 6 out of 6 with the buy signal since 1019. Primary market condition remains in a weak bear, as dictated by the relationship of key moving average lines. Stock charts decision points. Still relatively weak on the intermediate and long term, though short term has been much stronger. Intermediate term market posture still very bullish. It still has upslope sentiment. Position sizing opinions, both systems are charging 100%. And in terms of intermediate term market posture specifics, S&P very bullish, Dow very bullish, NASDAQ also in the very bullish camp, and Russell back to the bullish camp. So really nothing to be scared of from the settings in the intermediate term market posture. Hedge warning status still remains level 1. We still do have some elevated risk factors in this market, but they're still relatively shallow and controlled, nothing too worrisome at this point. We do have market in decline and sharp increase warnings that have fired and continue. We have this kind of worrisome NASDAQ with 4 distribution days. It's not quite a warning yet, but certainly is growing towards that level. We still have this elevated skew. And then we still have on the intermarket risk aversion indicators, a couple of these have just barely turned positive. One's neutral, so perhaps not as bullish as this might seem, but still, greatly favoring the bulls versus the bears. New York Stock Exchange new highs, new lows, 387 for the highs yesterday. So even though we had general market weakness, that weakness was not, widespread or particularly deep, at least with respect to the New York Stock Exchange. In terms of special opinions, VIX is within the acceptable window for novice traders to initiate new option income strategies. Might want to consider reducing the position size on anything that you initiate, given for the potential higher than normal delta and vega moves, given that current skew level. And then also, we had that intermediate term bearish cluster about 3 days ago. That may have already resolved itself. We'll have to see if we get continued follow-through weakness. Cover call strategies also. Conditions are cautiously bullish, acceptable to initiate new positions for novice traders. Consider a 2-to-1 ratio of out-of-the-money and in-the-money strikes. Also a 2-to-1 ratio of higher beta versus lower beta positions. So mix it up a little bit. Be a bit defensive, but yet also feel that the conditions are appropriate to initiate new positions and take advantage of opportunities that you might identify. Consider reducing the position size or legging into cover calls through well out of the money put selling on some of those more aggressive entries, especially those higher beta entries. In terms of put selling outright, you might want to also, if you're needing to be defensive, consider defined risk positions. So instead of just a naked put, spread that into a bull put spread, and then also scale into the position that you're willing to own. And always keep that always in mind. Don't buy or sell more contracts than you are willing to own in shares with your put selling strategy. In terms of sector specific, short to intermediate, you see a little bit more mixed signals here. Healthcare and retail just flat out down now, so quite a bit of deterioration from yesterday. And always note which sectors are the first to deteriorate, which sectors are the first to improve as markets turn. Well, right now the answer is healthcare and retail are the first to turn negative, followed by energy and materials. So if the market were strongly bullish, you would have a lot more strength out of some of these sectors, such as technology, and for that matter, the commodity index will need to participate if we're going to be in a strong bull market. Of course, financials also need to be a strong bull market if we're going to be, really a healthy bull market, and we're just not seeing those kinds of signs. We're seeing general bullishness. We're expecting, of course, to be, bull flags and the like, as we said earlier. But at the same time, we still see all these signs that things are not, all out healthy bull. So when you think about that hedge risk level 1, as opposed to being a level 0, these are the kinds of things that start popping out to you. In terms of sectors percent change, here you see generally negative yesterday. Only industrials managed to put in a positive day. But look at the 5-day and the 1 month, still things, generally positive. And in that more intermediate term, and But at the same time, this has been a very choppy market. And you look at the 3 month and year to date, they're generally negative. So these are mostly traders markets right now, requiring for nimble entries and exits, and not getting terribly loaded up on either side of the market. You might even want to consider some bearish trades as well as your primarily bullish trades given our current intermediate term market posture, but have perhaps a couple bearish trades mixed in there to take advantage of these swings in the market that certainly seem to be the trait of 2015. Well, that should be enough for today. As always, if you find this helpful to your trading, we greatly appreciate you subscribing to us on YouTube and liking us on YouTube. We're about to hit a landmark there. We're about to hit our 100th subscriber to our YouTube channel, and which is really quite remarkable given that we've not been doing this very long. We greatly appreciate your noting and subscribing to us. We take that as a sign of appreciation and acknowledgement that we're doing things that are helpful to your trading. Retweet us to your Twitter followers, to your stock Twitter followers, etc. Email support at falconglobaltraders.com. Opportunities available and additional opportunities available. Disclaimers as always, hit the pause button if you need more time to review this. And we'll see you back here tomorrow morning before the market opens with the Falcon Global Market Preview. Good trading.